हेलो स्टूडेंट्स, वेलकम टू CS EduHub। आज के इस वीडियो में हम डिस्कस करेंगे कैपिटल बजटिंग की एक टेक्निक। कैपिटल बजटिंग एक मैनेजमेंट डिसीजन टूल है। Whenever company wants to make a capital decision, that is, if company wants to invest its huge capital, so before investing, company has to make a decision whether to invest into that specific asset or that specific project or not. So to decide upon, a tool is used that is called as capital budgeting, or the entire process of that decision making is called as capital budgeting. So in capital budgeting there are various techniques or method to make a decision. So we are going to discuss one important method today, that is NPV, that is net present value method. Net present value. This is a method where we convert the future cash flow into the present value and then we compare the worth of investment. ठीक है? So क्वेश्चन हमारे पास है जहां पर हमें पता है कि कंपनी 5 लाख रुपीस इन्वेस्ट करने वाली है. So initial investment or the cash outflow is rupees 5 lakh and the cost of capital is 10%. That means company should at least be able to recover 10% return on its investment. Further, we have 5 years expected cash inflow. So this is called as cash flow, or you can in short call it as CF, that is cash inflow. So we have 5 years data. So each year company is expecting to earn certain amount as cash inflow. Now we are supposed to take a decision whether company should invest into that project or not. So let's consider we are investing 5 lakh rupees. The cost of capital is 10% and this is the expected cash inflow that we can generate over a period of 5 years. Now we have to use net present value method, that is NPV method, to take a decision. So let's discuss what we are going to do. So we need a table wherein years cash flow is given in the question. Now for calculation purpose we will have to calculate DF, that is discounting factor. Discounting factor is the rate at which the value of rupee will discount or reduce over a period of time. So every year value of money will reduce due to inflation. Now this rate is 10%. So whenever we use DF, the rate is considered which is given in the question, that is 10%. So if the question says cost of capital is 10%, or if the question says return on investment is 10%, or expected return is 10%, all means the same thing, that is this is the rate which we are going to use as DF. So we will have to calculate DF and then we will calculate PVCF, that is present value of cash flow. So this is the future value which we are expecting to earn every year and we will convert it into present value and then we will make a decision. So let's start. So first thing that we will have to calculate is DF. Now formula to calculate DF is equal to 1 upon 1 plus R by 100 raised to N. Right? So it's nothing but inverse of compound rate of return or compound interest. So we know that the formula for compound interest is 1 plus R by 100 raised to N. This is the inverse of that, that is DF. So we will use this formula to calculate DF of each year. Now how do we calculate? The calculation is very simple. 1 So for first year it is 1 divided by 1 plus R. R is the DF rate, that is 10%. 10 by 100 raised to 1. Right. So n is the number of year. So for first year n will be 1. So 1 upon 1 plus R by 100 raised to n. So if we calculate, we will get the value which is 0.9091. So we have consider rounded off value 9091, 0.9091. Now how do we calculate? You will have to use the calculator. So I can show you how to calculate the value, for each year. So how to calculate DF? Let's use the calculator. Now you can see in the calculator that what we have to type is 1 divided by 1.1. Now when we press equal to button, we get the value, that is 9091. This is for the first year. Now when we put or press the equal to button for the second time, we get the value for second year. So DF for second year is 0.8265. Now when we press equal to button for the third time, we get the answer 0.7514. This is the DF for third year. Then again for fourth year, press the equal to button, you get the value 0.6831. And then for fifth year, the answer is 0.6210. So this is the method to calculate DF, or how to use the calculator to find the value of DF. DF is calculated, we have put it in the DF column. Now next column is PVCF, that is present value of cash flow. How to calculate that? It is nothing but CF into DF. So CF column and DF column, the product of it is PVCF. So what we will do is 1,20,000 multiplied by 0.9091. Whatever answer we get, we will write in the PVCF column. So let's calculate 1,20,000 multiplied by 0.9091. The answer is 1,09,092. For the second year, what we will do is 1,50,000 multiplied by 0.8265. So it is 1,50,000 multiplied by 0.8265. The answer is 1,23,975. For the third year, 1,70,000 into 0.7514. The answer is 1,36,620. So this is the PVCF of each year. What we have done is we have multiplied cash inflow of each year with the respective discounting factor. So for every year we have calculated the PVCF. Now next step is we need to do the total of this. Total of PVCF. So it is nothing but total of all the values of PVCF. So let's first calculate the total. 1,09,092 plus 1,23,975 plus 1,27,738 plus 1,36,620 plus 1,36,620. The answer is 6,34,000 045. So 6,34,045 is the total PVCF. This is total PVCF. Understood? So cash inflow multiplied by discounting factor is PVCF. Total of that is called as total PVCF. Now to calculate NPV, what we have to do is we have to subtract initial investment. Now what we have earned is 6,34,045 and what we had invested is 5 lakh. So deduct this 5 lakh. We get answer, that is 1,34,045. This is called as NPV. So the net present value of this investment will be 1,34,045. Done. Now since we know the investment net present value is 1,34,045. That means we have invested 5 lakh and we have earned 1,34,045 rupees over and above initial investment. That means we are earning profit. So whenever NPV is positive, NPV is positive, we invest in the project. If NPV is negative, we do not invest. So whenever NPV is negative, we do not invest. Understood? So this is the decision making criteria. Process is, we know that we are investing 5 lakh rupees. The cost of capital is 10%. This is the expected cash inflow. So the first step, we calculate DF at the rate of expected expected cost of capital. Then multiply cash flow with DF, you get PVCF. Calculate the total of it. It is called as total PVCF. Deduct it with initial investment, you get NPV. So the formula for NPV is total PVCF minus initial investment. If NPV is positive, you invest in the project. If NPV is negative, you should not invest in the project. I hope you have understood with the method. If you have any doubt in this method, you can ask me and we will discuss further. Thank you for watching this video. Bye bye.